Panel of DebCon. I'm very happy that Benoit Coeuré is chairing this panel. So Benoit is currently the president de l'Autorité de la concurrence, which is a kind of FCC, the French FCC? Yes, no, more or less. And has a long career at the ECB, at the BIS, but maybe most importantly for this crowd, was the vice president of the Paris Club for a few years, and has a long experience for dealing with the question of geopolitics and debt. So who better than him could chair this panel? So I'll give him the floor and to the panel and so this last session we'll have a short closing session to thank everyone at the end, and then we'll close.
Thank you very much, Martin. Good afternoon, everyone. I'm very pleased to be here. What Martin didn't say is that I spent part of my career issuing debt, and then the next part of my career buying debt, moving from the French Treasury to the ECB, and in between I did debt restructuring. So I didn't have the chance to do debt restructuring for France yet, but you know, maybe that comes one day. I think it's very telling and appropriate that the organizers chose to have this concluding panel dealing with the geopolitics of sovereign debt. We've been used to think of the sovereign debt market globally and of sovereign debt restructuring historically within a given set of constraints and parameters which have changed a big deal over the last 20 years and keep changing. Even when I was at the Paris Club, as Martin reminded, that was 15 years ago, and we were already dealing with evolving debt structures. I mean, shifts from credit to bonds, obviously, to bond finance. The rise of private creditors as opposed to official creditors, and also the rise of non-Paris Club creditors. I remember a couple of trips to Beijing to discuss that, which weren't so fruitful at the time, I have to say. And that is still around us, but we also had since then the rise of what I would call the US-China strategic rivalry at the center of the system, which kind of impacts a lot of the discussions we're having today. And also, of course, on top of these kind of low frequency, slow moving shifts, we also had big shocks to the system lately, the COVID pandemics, the energy crisis, which have strained, I mean, all economies in the world, but particularly emerging and low-income economies, and have also added complexity to the discussion. And then looking ahead, we have daunting challenges such as the financing of climate change, obviously, which kind of adds a big liability, a big off-balance liability to everything we're discussing today. So it's getting even more complex by the day. It's all about politics, because of course you have all these different players with different interests, and the balance of power in the world has changed a lot since particularly since the Paris Club was not only created, but also since the Paris Club established its procedures and protocols. Of course, there have been efforts from the official community to adapt to this. Oh, that's great! Thank you very much. There have been efforts by the official community to adapt, particularly as we know recently through the common framework, the G20 common framework. I think there is we can start from the point where we all agree around this panel that it falls short of addressing all the complex issues that I've thrown at you. So. The good news is that we have a really stellar lineup of speakers to discuss all these issues. I'm not going to go into all your achievements and and curricula and titles, because that would take the whole of the 90 minutes we have for the discussion. But let me just introduce the speakers. So let's go from right to left. So we are from left to right from your perspective. So Karina, Patricio Ferreira-Lima is an assistant professor at the University of Leeds, and please correct me if I'm not if I'm wrong. Polina Kurdyavko is head of emerging markets at Bluebay Asset Management. Reza Baqir is a managing director at Alvarez and Marsal, which is a law firm, and also a senior fellow at the Harvard Kennedy School and a former governor of the State Bank of Pakistan, and a long-standing IMF staff initially. Armand Zorn is a member of the German Parliament, coming from a lovely constituency, which is Frankfurt am Main, place which is dear to my heart. Yeyu is an assistant professor and an assistant director at the Institute of World Economy at the Shanghai Institute for International Studies. And last but not least, we have Layna Mosley, who's a professor of politics and international affairs at Princeton, and Jeromin Zettelmeyer, who's the director of Bruegel, and also former IMF. Just to, I think that will show up very, very, very soon when you start speaking, but we'll see, we'll see. So without due delay, let me start that discussion. And I wanted to start with Professor Mosley, to kind of set the stage in terms of how political science can help us understand what's going on and what's the role of geopolitics in framing the functioning of the international financial institutions. So, Layna, the floor is yours.
Okay. So I should apologize at the last session of DebCon for putting up slides. And I want to promise you that there are only 4 of them, and that's not the first one, but that's okay. So I'm a political scientist, and what I thought I would do today, with apologies to the other political scientists who have heard these things, is say a little bit about how we think about how countries pursue their interests in general and in international finance specifically. And this is all premised from this thought that governments of democracies, autocracies, rich countries, poor countries, are all focused on their political survival. They're thinking about what helps them to stay in office when they're making domestic as well as foreign policy. And so when we think about this in the context of finance, we know that there are governments that use foreign aid as well as concessional finance, that is to say bilateral official credit, to achieve their objectives. These objectives might be more in the realm of so-called soft power and public diplomacy, using finance and overseas projects to kind of improve mass attitudes toward that country. It might be more of the kind of hard power variety in terms of using finance to get access to trade, resources, for security reasons, and the like. And I think it's important to keep in mind that when we're thinking about wealthy countries serving as creditors, we can also think about borrowing countries who themselves are going to have preferences over creditors. And so it's really a supply and demand story here, even as we focus perhaps on the creditor countries. If we think about this instead in a multilateral context, we have a long set of studies in political science and political economy that demonstrate that the IMF and the World Bank's decisions reflect not only, but partly, considerations of the interest of the most powerful shareholders. Not to say that this is always going on, and there's some debate about whether or not this is major shareholder governments sort of directly trying to put their thumbs on the scale, or if this is about staff kind of intuiting that these kinds of pressures are out there and adjusting their behavior preemptively. But in any case, we know that IMF loan size, IMF conditionality, the enforcement conditionality, the tenor of DSAs even, is explained partly by the interest of powerful countries. And then finally, we also can think about the fact that private creditors are also aware of these kind of larger political dynamics. So there's a recent paper, for instance, by Lauren Ferry and Patrick Shea, two other political scientists, that find that countries that are geopolitically closer to the US restructure their debts at higher rates, but also receive less market punishment for those restructurings. And so we could think about some sort of overlap in the treatment in the private market with official creditor, with government interests. Okay, so that's the first part of it. The second part of it, maybe, can you flip to the next one? Because I can't, despite my clicker. The second part of this then gets us thinking about how geopolitics matters for global governance. And so we can go back a long way in history to think about the fact that the creation and the design and now the functioning of international institutions reflects the interests of powerful countries. So we can go back to the negotiations for the IMF during the Second World War. We can think about the role for the dollar that's cemented in the IMF and the so-called exorbitant privilege that this thing gives the US going forward. We also might look more recently to the case of the AAIB and its founding. And there we see that the founding members, including China, turn out to then rely less, as we might think, on World Bank project finance. And so there's recent work by a colleague of mine, Jim Freeland, and his co-authors, where they find that even once you account for all the different things that might be driving the choice of lending, you see this shift related to the AAIB's presence away from the World Bank. Now, of course, the rise of new creditors, whether it's the AAIB or it's new bilateral creditors or it's private sector credit, creates opportunities for borrowing countries. And so I think we often think about this diversity of creditors as being problematic when we start to think about dealing with debt crises, but it also is going to give opportunities, I think, in many ways to low and middle income governments. Where we are today, of course, is that transitions in the allocation of power globally disrupt the functioning of these institutions and especially the resolution of debt crises. I have a recent paper with Cameron Ballard Rosa and Peter Rosendorf where we show that to the extent that you have debt to China, you are less likely to conclude a Paris Club restructuring agreement. And that's really a China story. That is to say, when we look at the presence of other sort of new bilateral creditors, that doesn't seem to make a difference. Lauren Ferry and Alexandra Zeitz also have a recent piece where they find that to the extent that you have debt to China, your negotiation of an IMF program tends to go slower. And so we certainly see these dynamics making a difference in how this works. I have a next slide that is it's a picture to get at this a little better. And this is actually the reason why I have slides, is so I can show you this picture, which you probably can't read. But these countries are countries that are in debt distress or at moderate or high risk of debt distress. And the blue dots are their ideal point distance from the United States. The ideal point distance measure, someone sitting in the room, Eric Booten, Eric, you can wave, is the person who has created this measure. It's based on key votes in the UN General Assembly. You've seen it now because it's been used in the World Economic Outlook and other places too. But it's trying to get at the distance in ideal points between any given country and here, another country, the US. The red dots are the same thing, the ideal point distance from China. And then the red dots are bigger to represent the size of a country's outstanding debt to China by our best estimates. And then the light colored dots, the light blue and the pink, are where these countries were 5 years ago. So it might give a sense of the direction of movement. So one thing that might be striking here is to see that many of these countries that are at high risk of crisis are geopolitically closer to China than they are to the US. And this again kind of gets us back to thinking about how things might be being disrupted by these global shifts in power. Okay, so I have one, but actually two, but that's fine, really one more slide, just to get us then to think about my final point, which is that yes, we're in a world in which geopolitics seems to matter a lot for debt and debt outcomes. I would argue, of course, that international politics has always mattered for debt-related outcomes, but we're also still in a world in which governments are thinking as well about domestic politics and their survival in office. We talked about this a lot during this conference in terms of thinking about when countries in crisis are willing to impose austerity or to go to the IMF and how much they worry about who bears the burden. But as well, on the creditor side, we can think about how domestic politics matters for how they act internationally, either bilaterally or through global institutions. So we have a lot of evidence that when domestic financial firms are more exposed to countries in crisis, those countries are more likely to get either bilateral or multilateral bailouts. We might think about how mass attitudes in democracies toward bailouts, foreign aid, financial assistance might change governments' willingness to help in crises. We know that export credit, which is kind of part of bilateral official finance, provides benefits to firms in creditor countries. So there's a domestic politics there as well. And I think the final thing I would sort of think about here is in the context of China and Chinese debt, we sort of remind ourselves that there are a diversity of creditor institutions in China. And we can think about the extent to which staff of Chinese policy banks are very hesitant for career reasons to go and ask their bosses for restructurings. And that this is part of the story is not so much about power competition, but it's about the sort of bureaucratic or kind of staff incentives to which we should pay more attention. Okay, so I just want us to sort of maybe have these things in mind as we go forward. Somebody seems to have put something else, yeah, go on, into my slides. And I don't know, right? So, so some of you will know, this is my chance to say a collective thanks to Martin and his team, but also to Anna Gelpern, who sort of first had this DebCon idea, and she organized the first DebCon with Mitu Gulati. Mitu thought that DebCon was so much about geopolitics that he is spending this week in Normandy doing some cycling. So that's a great power reference. And so now that we've roasted Mitu a little bit, we may move on to our next speaker.
Thank you. Thank you so much, Layna. I would like to turn to Karina and building on everything we've heard, building on everything we've heard already, maybe focus a little bit more on the kind of shifts that we've seen in the system recently, the poly crisis, as it's sometimes called, and how it does impact the geopolitics of debt and also the international financial institutions.
Thank you. Yeah, also following up on the previous comment, I think I have big shoes to fill because Anna was originally in this panel and she kindly, I think to the benefit of, because we are already a huge group, stepped down, and since we are both of us are legal scholars, I feel like this is too much, kind of the big shoes. So I hope I can I can honor her kindness. So in terms of the question, I suppose the audience is familiar with the term, the poly crisis, right? This is has become a huge kind of thing, a term that is now commonly used. It was used for the first time in 1999 by Morin and Kern, but was recently kind of, I think, popularized by Tooze to describe the prominence and then to the nature of overlapping crises at the moment, right? We have several different types of crises: the pandemic, sovereign debt crisis, climate change, energy supply chain, etc. And they are all overlapping and interconnected emergencies, which I think depicts a sensation that we have today of these polycrises. But then one could say, arguably, we've always had several simultaneous crises. What is new about the current moment, right? And I think I've been thinking about that a lot. And I would say the distinctive feature of the present is that we are not only seeing overlapping crises, but also collective action problems that emerge from the current crisis of multilateralism in this kind of transitional moment in world order. Currently we have this, what one would call post-Bretton Woods system, which has been around for 50 years already, right? And it remains powerful, influential. It's the foundation of our global order, but also it's being progressively overshadowed by something that we are still not sure what is, an order that is yet unclear. And I think that we are seeing ramifications of the current crisis of multilateralism in all areas of global economic governance. In international trade, we now have increasing tariffs, export bans in the tech sector, in the food sector. We have the appellate body crisis at the WTO. In international finance, we have the multiplication of sanctions, what one could also describe as weaponization of the dollar system. And the net result of all those kind of crises that ultimately emerge from a crisis of multilateralism is that it leaves the most vulnerable populations in the international community, both countries and vulnerable populations across all countries, wrestling with the polycrisis. So for example, let's think about the pandemic, the failure to democratize access to vaccines, for example, right? And the ultimate outcome is yet uncertain, but there is an increased trend towards inequality, at least in most, perhaps not in Asia. Branko Milanovic talked about that a lot, right? But elsewhere, perhaps, when you think about global inequality and inequality within traditional Western countries, but also other areas of the world, but political unrest as well, extremism, conflicts, etc. So in the domain of sovereign debt, I believe, we've never really achieved real multilateralism from the perspective of the majority of the world because we lack an efficient expedite mechanism to deal with sovereign debt crisis, and that enables sovereigns to propose compromises or arrangements with creditors that are enforceable to restructure their financial obligations. And this has been a long-standing advocacy theme for most countries in the global south. UNCTAD has been advocating for that for decades. We have UN resolutions on that from 2014 and 15, which were voted by an overwhelming majority of countries, 135 votes in favor and only 6 against. So I think this is very important because the UN now, as we approach an era of kind of a crisis of multilateralism, is the only forum we really have all countries. It's a kind of truly democratic forum, right? And it's crucial, I think, in an age of fragmentation and so-called decoupling. So in this moment, we see a complexification of sovereign debt markets. And the crisis of multilateralism becomes more visible in this context because we have achieved a unique level of complexity where sovereign debt markets now are as complex as any other credit market. But unlike every other credit market, the evolution of sovereign debt markets has not been paralleled by the establishment of preset and binding rules of engagement to restructure those financial obligations in the episode of debt distress. Examples of complexification, for example, are we see collateralized instruments, we see the return of syndicated loans, which present transparency issues. We also see state contingent debt instruments that can complicate the assessment of debt sustainability and the negotiation of restructuring terms. And the geopolitical implications of complexification are that it's increasingly difficult or challenging to agree upon the terms of sovereign debt restructuring processes, and as we are seeing in practice across several different restructuring processes. And this is a major problem within an international financial architecture that has so far primarily relied upon creditor choice and the logic of creditor clubs. Currently, sovereigns undertaking restructuring processes must generally negotiate with 3 important groups, as we all know, right? We have private creditors, we have Paris Club creditors, we have non-Paris Club creditors, and these, as we've been discussing in this conference, have different interests, they have different preferences, and also practices, different practices when it comes to that restructuring. And so the consequences of complexification of sovereign debt markets is that it is exacerbating problems that we already were familiar with in the past, such as delays in restructuring processes and also insufficient debt relief to put countries back on track, right? So this only compounds to the problems that we already had before. Fundamentally, none of the three creditor groups will, because for obvious reasons, and we must all, I think, acknowledge and understand the reasons why this is so, wants to agree upon restructuring terms until they know that they are certain that the others will also agree, or that they would take a similar kind of level of loss, right? And so we see this new reality of classic fear of free riding, where creditors will fear that other creditors will benefit from the restructuring, so they opt not to engage so much, or at least not until there are commitments. And this creates a strong incentive for non-cooperation. So to sum up here, for me, I think the poly crisis is most and foremost a crisis of multilateralism. This is the primary field where leadership and public accountability are needed to address the greatest challenges of our time, and sovereign debt restructuring and dealing with sovereign debt crisis is one of them. And if we fail to achieve a multilateral solution to improve the current fora and rules of engagement, I think we are effectively committing to more lost decades of systemic vulnerabilities, low growth, low investment levels, and increasing socioeconomic vulnerabilities. And just to illustrate, as UNCTAD has recently highlighted, half of humanity right now lives in countries that spend more paying interest on debt than on health and education. So I think this is a crucial theme of our era, and it's a place where we should all show a strong commitment to engage in a conversation to improve our multilateral framework for sovereign debt restructuring.
Thank you, Karina. I would like to particularly thank you for not only describing a crisis, but also starting to provide solutions, which we very much want to do on this panel. But before we come back to the solutions, I think we can't do that before having a sense of the different perspectives in that discussion. And we are lucky enough to have a very diverse set of speakers coming from different places. And so I would like to start that part of the discussion with Reza, coming from, well, you have the IMF background, but you also have the perspective from Pakistan, which is very useful in that discussion.
Thank you, Benoit, and to the organizers of DebCon7, great set of papers, great venue, and I remember I was at the first DebCon with Anna and others, so really great to be back over here. I want to start by saying that I really liked the framing of the issues that Layna put up in terms of the role of politics, and what I'll do is try to just illustrate with a few anecdotes from my experience, particularly in Pakistan. And Pakistan, as some of you may know, is a country that wants to be good friends with the West, including the US and Europe, but has the predicament that these friendly countries have stopped giving money to Pakistan. They used to, when Pakistan was fighting the Mujahideen when the Soviet Union had occupied Afghanistan. After that, money just dried off. And Pakistan has countries the countries that give money to Pakistan now are China and the Middle East countries. And so how does this geopolitics play out? And I'll speak also because I was at the governor of the central bank in Pakistan from 2019 to 2022. That's the time when we had to negotiate a new program with the IMF. And previously I used to be the head of the debt division in the IMF, working with many friends, have known Jeromin for some time, and suddenly found the same policies being thrown back at me in a very, very, I couldn't figure out why the IMF can't see that, Pakistan is very special, it can't tell. So I'm going to illustrate what are my takeaways, and I'm going to start with the following, just a few facts. So Pakistan's total debt, public debt is $250 billion. Of this, about $100 billion is external debt. And of this 100, $7 billion is only the amount that is due to Paris Club creditors. Non-Paris Club creditors are $34 billion, and multilaterals are about $40 billion, okay? So that is just to illustrate the role of the traditional creditors in Pakistan's debt profile. Also, Pakistan has been getting non-stop IMF programs since that 2019 program we negotiated. But the net flows from the IMF are now nearly zero to Pakistan. So right now, if you look at Pakistan's total payments to the IMF over the next 5 years, they're going to be about $6 billion. Pakistan is currently negotiating a new program with the IMF. It'll be lucky if it gets $6 billion, essentially to repay what it owes to the IMF. So China, the Gulf are the major creditors. Net inflows to Pakistan from IMF and others are going to be close to zero in the near term. So how does this pan out? My view is that I think the current obsession or the debate or the framework to extract deep restructurings out of non-Paris Club creditors, I think has gone probably a little bit too much in that direction. And I want to explain why I think so. I think it's better to think in terms of burden sharing amongst different bilateral creditors, not in terms of just debt restructuring and the losses that are going to be imposed on different sets of creditors, but rather losses that are going to be imposed and also new lending to these countries. Now, if you look at Pakistan, it's going to have a lot of financing needs for infrastructure, for climate-related calamities. I don't know if you remember when floods hit Pakistan last year, tens of thousands of people lost their lives or displaced. The estimates were $20–30 billion. And so the question then becomes, who are the countries or where is Pakistan going to get this finance? And as I shared with what the IMF has on the cards, what the World Bank has on the cards, that's not where the money is going to come from. So the point I want to make is the following. If a country like Pakistan, in the context of the current program discussions, were to get into a debt restructuring discussion, I think the current framework would not be very good for what comes out for Pakistan. By the current framework, I mean essentially the minority of bilateral creditors would want to see Pakistan impose heavy, deep restructuring, deep reduction to the obligations that Pakistan has to countries like China and to the Middle East countries. And the reason, so think of that as one, and think of another system where essentially we look at things differently. We say, okay, all bilateral official creditors, all we ask of you is to just maintain your exposures. And we just focus instead on some of the key structural reforms that Pakistan needs to do, such as the tax to GDP ratio, such as the energy sector losses. We get through the program period by addressing those structural areas. And then we don't need to worry and get involved in the rest. And I want to argue that that is a much better system. I want to argue that because, including in my time when we were doing the IMF programs, there was so much obsession, so much effort put on making sure that other creditors give new bilateral financing, that structural reforms suffered. Pakistan's tax to GDP ratio today is the same as it was in 2019, after nearly 5 years of an IMF program. And I think part of the reason is that so much of the focus has been on below the line items where the financing is going to come from, that some crucial things have not been done. So think of a system one where the message to the bilaterals is you just maintain your exposures. We as the IMF and others are going to focus on some structural reforms, give you the breathing space. And then after the program period, like with all surveillance countries, the IMF is not does not have the legal mandate to then intrude upon and say, how does Pakistan borrow? Hopefully, Pakistan gets out of that. If you contrast that with the system where Pakistan gets into a debt restructuring discussion, heavy losses are imposed upon the majority of the bilateral creditors, then the consequence is that these bilateral creditors are not going to be around to provide the needed financing. So for a country, and every country wants to be sovereign, no country wants to be in the IMF for too long. Pakistan does not want, the IMF does not want, any country to repeatedly borrow from it. The reason I think it's a better system is because then you do not turn away the current major capital providers to a country like Pakistan by not imposing deep losses on them. And it's better not just for the borrower, but I think it's also better for the IMF, because then you have countries like China and the Middle Eastern creditors who are going to continue to lend to Pakistan beyond the program period. And in fact, that lending is going to provide for the IMF to be repaid. I think it's better for the private sector, especially the new bondholders, because they will see that the creditors that really matter are still friends with Pakistan. And I think it's better for Pakistan because it is going to get the financing that it needs from some countries who are there and willing to provide the financing. I'll finish with an anecdote, which is that when I was at the State Bank of Pakistan, and I was there for 3 years, and at every review we had this problem of financing assurances, and we didn't get a very big program from the IMF. I wish we would have gotten as big a program as the IMF had given to Argentina or to Ukraine or to Greece in terms of percent of quota, but we got teensy tiny amounts. So we had to generate, we had to go to other ambassadors and generate bilateral flows. And so China and the Middle Eastern countries, was very straightforward. But the interesting conversations were with the Western capitals, because they were very keen that, we restructure the debts that we owe to China and to others. But when I would ask them, so commensurate with that, would you put up some more money? Maybe roughly in the same, or maybe half of what these countries are giving? And the answer would be no. So for a country that is sovereign and is looking at one set of creditors that are not interested in being there to support beyond the program period, and then it looks at another set of creditors that most likely are going to be there because they have geopolitical interests in that country, I think it's unfair to ask to be really tough on those countries that are going to be around when the IMF program is over. So in short, my conclusion is to rethink a little bit about talking too much about extracting losses on the new creditors. Think a little bit about not just countries of Pakistan, but many other countries. Who are the countries that are going to be around to lend to these countries? I think it's fully consistent with what has happened in the past and would also be better for the IMF because it would be in these countries for a shorter period of time. Thank you.
Thank you very much, Reza. I think it's a fascinating experience, and listening to you, I was thinking it's a lot about the kind of discount rate you want to use in that discussion. I mean, how to balance short-term adjustment, which is needed. You need adjustment with the longer-term perspective of graduating from the IMF and coming back to normal financing. And then it's about which discount rate you want to put on the discussion. And different creditors might have different discount rates, which I think is an important parameter in that discussion. So let me turn to Armand. So Armand, you're a German politician. So what can Germany do and what can the EU do to help?
First of all, let me start by saying thank you for having me. This is my first DEF conference, and I have to say it's been really interesting, and I got a lot of input from my work as lawmaker in Germany. And also what was really interesting is that during the breaks and also during the networking session, a lot of you were asking me, what is a German policymaker doing here at the DEF conference? So I guess this panel gives me the chance also to answer this question. Why is this topic of debt restructuring, debt management, why is it so important for Germany and for the European Union? And I'm not talking about our own German debt. I think there we have other problems. We have the problem that we are investing way too low, and we need to increase our investment. But I want to argue, and following what you have said, Professor Layna, I want to argue how important sovereign debt has become even for us in Germany and for Europeans. And there are a lot of arguments why you should argue that Germany should care about and Europe should care about. Let's start by what you just said, that we are more and more facing common challenges, global challenges that you cannot achieve, that you cannot solve on the national level. Germany is not going to be able to fight climate change, to fight global pandemic, to reduce poverty, to get control and get control of all the migrational issues and consequences associated with that just on the national level. So more and more, we understand that it comes to countries having the financial capabilities and being able to do the right policy measure in order to make sure that we commonly fight these global challenges. So I would say this is definitely an argument that even if you're seeing it from a national point of view, you need to understand that you're not going to be able to serve it everything from Berlin or from Brussels, but that you more and more need more countries that have the right mix of instruments and definitely capital available in order to achieve also these objectives. So it's our own interest to make sure that sovereign debt management is more sustainable for all of us. And the second argument, and this is probably also more and more increasing in Germany, that we tend to care more and more about €1 we're investing. I mean, taxpayer money is always kind of a hard business, and you always need to be really careful about what you're doing with that. But in times, especially in transformation times, where the amount of money you need to invest in social justice, but in transformation of the economy, in fighting climate change and so on and so forth, in this time, we tend to think that people are more and more focusing about their own business. We see protectionism and national tendencies where we're saying even middle right or middle left, center left parties are thinking more and more about what's happening in front of my door, and then later on we're going to think about the rest of the world. But so in these times, you need to be really careful about what you're investing, and you need to be really sure about the fact that you want to use taxpayer money and make sure it's used in an efficient way. So you want to avoid that you don't have the trust of the people, of your voters anymore, otherwise it's going to limit your possibilities to act in the future. But also in order to achieve your objectives, you want to make sure that you're really efficient and that at the end of the day, you're not bailing out private creditors with German taxpayer money. So this is the second argument why this is more and more important to us in Germany and to Europe. And then last, but according to me, definitely one of the most important arguments is that we in Germany and we in Europe, we have a strong commitment to the international rule-based system. We care a lot about that. So we in Germany and Europe, as an export-driven country and continent, not only because of that, but also because of that, we are actually very interested and very reliant on having international rules that apply to everyone and that are working. So by seeing such a big topic as sovereign debt and seeing everything that is happening there and seeing the lack of functioning rules, you have actually a lot of countries losing faith in the system, losing faith in multilateral institutions. And you have spillover effects, because it's not going to be like they're going to say, oh, we understand that the rules are not working when it comes to sovereign debt restructuring, but we want to comply with all the other rules. So what you're observing is that there's a rejection to our Western-based point of view and to our Western-based international rule-based system. So it's in our own interest, in Europe, in Germany, that we make sure that we have rules in place that are working, that are efficient, but it's also important that we make rules that are not dictated by the West. It's quite important that we jointly develop the rules, and to be honest, looking at the international financial architecture right now, we cannot say these rules are just, we cannot say these rules have been co-created, but we rather have to say these are rules made by the West that are sometimes very unjust, very unfair to a lot of countries of the global South. So for us to save the international order, we need to be willing to have a systematic reform of the international financial architecture, to have more countries of the global south being part of, being on the table and co-designing these rules, because we want them to also be, to develop in ownership over these rules, and that's why I believe it's quite important. And last but not least, and that's how I want to conclude, and here we're moving towards into the direction of what can we do, what are potential solutions. So I would just say a couple of sentences, and then I guess we're going to do a second round. And the most important part in Europe and in Germany is actually realizing the geopolitical instrument that you can use with sovereign debt. So until now, I would say, especially in Germany, we have been very technical and we play by the books. So we have a lot of, we have a big development aid budget, we have a lot of loans, we have the KfW, we have a lot of offers that we make, but we're being very reluctant to be bold about what we want and what we believe that is important. So what I always say that we don't need to do everything like the Americans are doing and like the Chinese are doing, but I believe that being more cautious about what are our European interests and what are common interests that we share with certain countries in the world, and what's the baseline in order to make an offer that is mutually beneficial is something we should take more into account. And this also means that sometimes we need to make an offer that may not be in our best interest in terms of pure economic value, but that is certainly going to help us to fulfill geopolitical objectives in the midterm, and that's the way we need to go. But I'm happy to say a bit more about the reforms later on.
Thank you very much, sir. Thank you very much, Armand. And if I may add a personal comment, as a European, we also, as Europeans, we also went through a very sobering experience, which is our own sovereign debt crisis, particularly in Greece. And so that has helped us also to kind of qualify and maybe moderate and some of our previous principles when it comes to other countries, because it just turned out that we had to ask for IMF support big time, and so I think we can be a little bit humbler and more sober in that discussion. But that's a personal comment. Turning to Polina, thank you for being here. There is one perspective that we haven't heard about yet, which is the perspective of the private sector. So please tell us how you see that discussion.
Thank you. Delighted to be here. It's my first DebCon, and I am pleased that alongside with Michelle, we can represent the private sector on some of the panels today. And I also hope that it goes to show that private sector is not a short-term institution focusing on maximizing short-term gains, but actually does care about long-term sustainability of countries in emerging markets that we invest in. I also love the fact that we started to hear some solutions coming from Reza, and we also are in a solution-oriented business. So what I wanted to share with you is our perspective on geopolitical risks and potential solutions to that. Firstly, I would separate geopolitical risk for the countries in the normal, and the impact of geopolitical risks for the countries as part of the normal course of business, and then the role that geopolitical risk plays once the country is already in the debt restructuring. So perhaps let's start with the first point. At the risk of sounding controversial, I would say that in the last few years, increased geopolitical risk has contributed in general to a much stronger economic performance in emerging market countries, and most likely much lower default rate going forward. Let me explain why. When we talk to our clients about risks, geopolitics is usually number one, and at worst, top 3 risks that is being raised when investing in emerging market fixed income. Now, if you think about what the client thinks from a geopolitical perspective, they're worried about headline risk, sanction risk, and economic risks. I think the headline risk is what it is. As long as it doesn't lead to economic impairment, we can deal with headline risk. But it makes it more complex to explain to our investors why one should invest in emerging market fixed income. Sanction risk is probably the most important risk when it comes to geopolitics, because it affects not only our ability to generate return, but it impairs the liquidity in the market. Hopefully, the recent and not so recent examples of sanctions that have been introduced have demonstrated that it might be not the most effective tool to deal with, if you will, to deal with countries' geopolitical risk in the context of those who impose those sanctions. And even recently, the examples of Venezuela, where ultimately being pressured by the migration problem, US has agreed to lift the sanctions, shows that the binary nature, if you will, of sanction regime is not necessarily effective in dealing with geopolitical risk or change in leadership. But I want to focus on economic risk. If you think about the last 3 geopolitical spikes that we've seen, Russian-Ukraine war, US-China tension / risk of China-Taiwan conflict, and Israel-Hamas, I would argue that all 3 had a positive economic impact on the rest of the world outside of the direct countries in case of Russia, Ukraine, and Israel-Hamas who were involved in this conflict. Why do I say that? Because if we look at Russia-Ukraine conflict, generally we've seen positive impact on broader commodity prices as a result of this conflict. Emerging markets are commodity exporters. Generally, we've seen some countries benefiting from cheaper commodity prices, like India with a lower gas price. And more broadly, we've seen that emerging markets, if you will, in general gained more independence, for the lack of a better word, when it comes to global geopolitical negotiating arena. When we look at China-US challenges and China-Taiwan crisis, actually it has helped countries like Mexico with the nearshoring, again, countries like India to gain economic market share, and even countries like Brazil and others to increase their exports to developed world. Now, of course, I'm not advocating by any stretch of imagination that we should keep geopolitical risk elevated. But I do want to say that when it comes to economic, if you will, evolution of emerging markets, if I look at where we're today, and by the way, most of the emerging markets that I'm actually focusing on are much larger beta-oriented economy. In most of those markets today, we're seeing almost a Goldilocks environment where we're seeing relatively hawkish monetary policy, relatively hawkish fiscal policy, and yet growth that for the last 2-3 years has surprised domestic policymakers on the upside. Now, by the way, this is part of it is what I say to our clients when I address their fear of geopolitical risk. In other words, the fear is that geopolitical risk per se doesn't lead to much higher default rate. However, when we think about debt sustainability, and I want to come back to the point that Reza has mentioned, what defines debt sustainability is not the stock of debt, and to some degree not the cost of debt. Let's not forget that Ecuador and Argentina, when they had to restructure their debt, had debt to GDP below 40% in both cases. What defines the debt sustainability is, of course, the policy mix, but also sustainability of the funding provided by alternative lenders. And what we have seen over the last few years, because of geopolitical risk by and large, I would say, emergence of alternative lenders of last resort. You know, Middle East is a classic example. Of course, China earlier on was lender to a larger amount of emerging market economies. And I think in particular in the case of Middle East today, some of this has been triggered by geopolitical risk and the willingness to prevent the escalation of geopolitics through an economic relationship they can develop with their counterparties and some of the weaker economies, namely in frontier markets, and obviously Egypt is the case in point. To me, this ultimately revises going forward the level of debt that is sustainable if it is accompanied by productive economic growth. I would also say that today, my observation is that some emerging market economies are doing more to support the long-term growth of their poorer cousins than developed markets. I'll give you an anecdote. We are trying to put together a program together with other private lenders to allow energy companies to use the funding, cheaper funding, to transition, in particular carbon emission reduction. As you can imagine, the framework today is not designed to support the energy sector for transition. In part of this exercise, we went to World Bank and said, would you mind joining us in this good cause and perhaps providing an equity tranche or a first loss tranche that would benefit global emerging market companies? And the answer was, we love the cause, but we're a lender with preferred creditor status. We are not able to provide any first loss pieces. We go and have the same conversation with the governments in Abu Dhabi, and we have a very different response. In fact, I should also note that if you look at global sovereign wealth funds assets that were spent on sustainable causes and methane emissions last year, Middle East accounted for more than 50% of total funding. We don't talk about those points on a regular basis. So perhaps referencing the point that Reza has made, the private sector and the alternative sources, alternative providers of capital are participating in making the debt more sustainable. And we would love to take a public sector along on that journey, or other multilateral development institutions. Now, then I will briefly talk about geopolitical risk when it comes to restructuring stories. When the default has already happened, in my experience, contrary to common belief, the geopolitics that you would have thought would be centered around relationship between China and Paris Club or the rest of Paris Club creditors hasn't been the biggest challenge in the restructurings. Yes, different speed of operating didn't help. Lost in translation in terms of anything from language to decision making didn't help. But ultimately we arrived to a similar destination. What I felt was quite disheartening is, to some degree, the voice of the private creditors that was not even at the table, was almost silenced as part of some of those processes. Because private creditors are viewed as these short-term investors that come and go, and ultimately, because there are so many players around the table and someone has to take the burden, the voice of private sector generally is the weakest. And that's where I think there is a strategic miscalculation. Firstly, when it comes to how much private credit really benefits, and by the way, in this case, I'm representing bondholders in real money accounts. How much are we benefiting from this restructuring stories? I've been investing in emerging markets since '98, and I'm still doing this job. So believe me, we're not all sitting in the kind of Elliott camp and making 300% returns on our investments. Secondly, when we want to discuss certain topics, our perspective should be a lot more aligned with that of public creditors. We have some of our biggest investors are German pension funds, are US pension funds. And when we talk about highly geopolitical restructurings, even in their case where economics takes a secondary step, or rather a second seat, we should be part of the discussion, and if we can help, discuss who should be taking majority of the burden, German pension holders or Russian pension holders. Lastly, I would leave you with one anecdote in terms of the stats. When I started this job, I looked at the allocation to emerging market fixed income in global fixed income portfolios of global pension funds. And it varied between 2 to 3%. At the time, the equity allocations in emerging markets were about 15%. I thought I hit the jackpot. Surely, in 20 years' time, the amount of percentage allocation that will be in investors' portfolio in fixed income has to be at least 10 times the number that I saw. Fast forward 25 years or so, we are exactly in the same percentage bracket when it comes to fixed income allocation, despite the fact that the asset class is $25 trillion. And the reason why the allocation to emerging market fixed income was so small is because there is plenty of risks from geopolitics to defaults and recoveries, and there is not enough of buying from, if you will, the multilateral community and global developed market governments that would allow private investors to align behind the slogan of, if you will, investing in emerging markets. And that's where we need developed market governments and multilaterals to be a lot more vocal. We are not the enemy and not the ones who are taking the majority of the losses because we don't have a strong voice. We need to create a solution that grows private allocation to emerging markets. Otherwise, we will be in these restructurings for many more years to come, and I don't think anyone benefits from that. Thank you.
Thank you very much, Polina. I've heard that you don't want the only one to take the losses, and you want to be part of the solution. I'm still digesting the fact that geopolitical risk is good for the economy. I still have to go through that.
May I just caveat that I don't advocate geopolitical risk to stay elevated. What I'm trying to contrast with is that generally geopolitical risk has been the main deterrent from the asset class, which is why we've seen 3 years as an industry of outflows. However, you are not seeing it in economic data, because actually economic data is the strongest we've seen in the last decade.
Thank you. I would like to kind of recenter the discussion around the multilateral system, which has been, of course, already mentioned many times, and that's about the role the Bretton Woods institutions can play, the role the Paris Club has been playing. G20 has not been very much mentioned, which is interesting per se. And so I will move to you. And also, of course, if you want to bring in the Chinese perspective, that's very welcome.
Okay, thank you, Chair. I'm very honored to be invited to this panel, and I've enjoyed a lot the discussions that I have heard. I think the discussions are very professional and candid, which is much better than the official level dialogue between China and the US. So especially.
Well, the bar has been set pretty low, but.
So anyway, so I'm here. I guess the audience would like me to share Chinese perspective. So I don't represent official Chinese perspective, just my reading of the Chinese position on this issue. I want to make 3 points. The first is China is in a very deep learning process, and a lot of progress has been made. It's delivering during learning. So IMF just concluded the Article 4 negotiation recently, concluding that China has played a constructive role in supporting the debt sustainability of the debtor countries. And I would say it's a bit surprising, actually. I've been partially observing the process, considering the very challenging China-US relations. I think the progress was made outside the China-US bilateral interactions, which is basically a multilateral process. As you know, that China and the US has established an economic working group last year. The debt issue is in the official agenda of the bilateral process. But if you follow that process, the priority issue of the economic working group is overcapacity rather than solving the global challenges. So I think China mainly relies on the international financial institutions to implement its priority. So on the debt agenda. So I will come to the topic about the role of the international financial institutions, including the IMF and the World Bank, especially on this aspect. So so now I come to the second point. Even though I think there's a lot of progress made and the concessions made by China, but if you ask how Chinese domestic policy field and academic field about, they don't congratulate that much as the IMF concluded. So actually, there's a lot of dissatisfaction. There's a lot of reflection about the BRI, but there's a lot of dissatisfaction about the G20's common framework as well. So so what are the dissatisfaction, the source of the dissatisfaction? I have three points to make. The first is about the narrative is not right from the many Chinese perspective. The debt issue is a common challenge, but instead of a China problem, I think many of our participants here would agree with this. But in the political narrative, it's framed as a pure China problem, and but actually it's a debt in US dollar. So China is actually in the dollar's debt trap. So so the more powerful, the more responsibility the actor should take. So it should be a common challenge, but the narrative is much more about China's obstacle on this aspect. And the second point, the dissatisfaction, my reading is that the international agenda on that issue is not neutral enough. It's not very much growth-oriented. But why I said this, I think I've heard many comments in my participation here. Too much emphasis has been put on restricting bilateral official creditors. And through debt reduction, through the haircut, rather they're providing new financing or seeking comprehensive solutions. So I think even before COVID-19, since 2008, the World Bank adopted the new package. The focus is on debt transparency, debt sustainability, so all this kind of new disciplines. And the World Bank and those MDBs have been seeking new reforms from billions to trillions, but aiming to solve the so-called global challenges. But in the 8 global challenges that is defined, there's no debt issue. So no commitment to provide a new support to debtors, but to those new. So that is the kind of the agenda is more on the reduction penalty, and also if we look at the debt restructuring process under the common framework, as I mentioned at the beginning, a lot of progress has been made. The speed has been much faster. Ghana and so that case is really a very important one, I think. So But the world seems to be not satisfied with China's progress. You want it to be much faster. So 5 months is not quick enough. We want 2 months or even faster. So I've heard a lot of comment on this. So it sounds like actually not many countries. So there's many discussions within China that actually not many countries are applying for the common framework. But there's much more push for the quicker progress. So it reminds me of the US new tariffs on the EV sector. So there's actually not much imports from China to the US, but US is adopting some kind of preemptive measures in restricting the imports from China. So it sounds like in the debt restructuring process as well, some kind of preemptive process is being pushed. And also the DSA, the appropriateness, the legitimacy of the DSA. I think there's a lot of academic research on that. But this comes to the central role of the IMF, especially. I think African countries are not very satisfied with the DSA. They think it's too restrictive. And all the problems seems to be like the climate indicators are being integrated in the DSA, so those kind of issues. And in China feels the DSA is not very much transparent. So anyway, so the agenda. And the third, but not the last, the dissatisfaction is to the burden sharing, but without power sharing. So since China considers itself still as a developing country, and in the climate area, for example, still insists on the common but differentiated responsibility principle, but still contributing more. But it feels not very much rewarded in the power sharing sector. One example is the international financial institutions shareholding voting power reform. The IMF just increased its quota, but without adjusting the share, while China is being contributed more to the common framework. So anyway, so to conclude, solutions. Sorry, I think the common framework still, I think, proves the resilience of the multilateralism, but I think it needs to be more concerned about Chinese perspective, probably more strategic solutions package, such as in the narrative side, focus on more the growth purpose, and also to be more balanced in the agenda, and also we need a kind of issue linkage between that and the other international financial institutions, reform institutions. Thank you.
Thank you very much. So let me finally turn to Jeromin and ask him the same question I asked you, that is, how can we improve our international governance arrangements? And maybe also, Jeromin, given your broad international experience, I mean, how bad is the sovereign debt challenge compared to other collective action challenges that we have?
Right. Thank you so much. And super to be here with all these fantastic people. Okay, so let me make three points. So first, in what sense does geopolitics complicate sovereign debt problems? Of course it does. I think the most, one rather obvious way in which it does is that it creates lending competition that will contribute to future sovereign debt crises, right? And so we know this from HIPC. HIPC was largely a consequence, not largely, but partly a consequence of the Cold War, of overlending, particularly to African countries, because of geopolitical rivalry. The Belt and Road Initiative is partly geopolitically motivated and has arguably led to overlending in many cases. And now we have a sort of European response to that, the Global Gateway, which is also about lending. And, of course, you know, this is not in an accounting sense inevitable, because you could, as a geopolitical power, curry favor through grants, for example, which would not lead to an excessive debt problem, but that then runs into problems of domestic political economy. So the sweet spot, sort of the intersection between geopolitics and domestic political economy, tends to produce excessive debt. And I think, you know, what Reza was saying is completely aligned with this. I mean, you were giving it a more positive spin, saying, you know, when we run out of money in Pakistan, we can turn to those new geopolitical players. And, you know, as long as your debt is sustainable, that's great. You know, but at some point, it's when you borrow too much, it's not so great. Okay, then the other sense in which everyone seems to think that it's obvious that geopolitics plays a role is because there is, you know, evidence that, you know, notwithstanding an improvement, the presence of China as a large creditor has complicated debt restructurings. Now, I guess the point I want to make is that that in itself is not enough to prove a geopolitical channel, right? You have to find a geopolitical causal story, because China may be different in more than in many ways, right? And so for me, the geopolitical causal story behind this, and I will tell you in a second that it's not the only story. My second point is precisely what Yu was referring to when she sort of explained skepticism vis-a-vis the DSA. So I think the reason why official bilateral debt restructuring after HIPIC was pretty easy is because the Paris Club and the IMF had figured out a division of labor where the IMF would come up with the so-called debt restructuring envelope and would basically act as a, you know, more or less neutral party between creditors and debtors. The creditor countries trusted the IMF. They were, after all, the main shareholders. And then the restructuring would happen. Now, it's completely clear that if you are China and you're in a situation where you are the largest, by far the largest creditor, and you're invited into a forum that largely copies Paris Club rules, you're not going to want to delegate this decision to an institution that, like Layna pointed out, is largely controlled, you know, by these piddly little bilateral shareholders that have a small minority of the debt stake, right? You're not going to want to play this game. You're going to essentially not trust the IMF to be neutral. You're going to probably think, you know, the IMF represents to some extent the interests of your fellow creditors on that official creditor committee. And, you know, it will most likely want to exaggerate the extent of debt relief that is necessary because it wants to protect its own money and by extension, the money of the other creditors that have these stakes in the IMF. So it's, for me, completely obvious. And it is indeed a reflection of the fact that there is this huge asymmetry between China being a very large creditor, bilateral creditor, but very small in its stake in the IMF. So that creates a very natural a conflict of interest. And this is how I sort of interpret this reluctance. Now, there's good news here because, you know, maybe the IMF and its governance can prove itself to some extent, right? So particularly with the US sort of getting nastier with China, China then can discover that actually maybe, you know, this governance arrangement at the IMF where the US doesn't completely run it is not so bad. And maybe they're actually relatively fair, right? And so certainly when I was at the IMF, that was our message. And I'm sure that's still the message of my former colleagues at the IMF. It was basically, look, we're trying to do an honest broker thing here and, you know, trust us. We are willing to explain our methods. And, you know, there's then a process of confidence building, which is maybe one of the reasons why this process has been working better slowly. Okay, then the second point I want to make, and maybe I'll forget my third point because it will just get all too long, is that, you know, even with respect to China, where geopolitics arguably plays a big role, there are other reasons, deep reasons, why debt restructurings may take very long, right? And so these are essentially domestic reasons. So Layna has given us one story, which is a sort of an institutional story, right? Incentives within organizations. Another one that's really obvious, and I think was alluded to in this morning's panel, is the idea that we have less, the relationship among Chinese institutions as far as restructuring is concerned is less clear than in Western institutions. And, surprisingly, to those that think of China as a pretty sort of, well-organized, centralized system, institutional rivalries and coordination play a very big role, and this is a problem. So, in Western countries, typically restructurings are run by ministries of finance, and in China, China is typically represented by Exim Bank, and Exim Bank has a lot to lose institutionally from admitting that a large restructuring is needed because it made those decisions, and we have fundamentally an autocratic system where there's always a sense that if you are caught making a mistake, and possibly with a shadow of potential corruption behind this, you can get into real trouble. And maybe there will be personal consequences, there will be institutional consequences. And so that is, I think, the main reason, probably more important than this geopolitics, of why Exim has tended to play a real hardball in these things. If China were represented by the Ministry of Finance, I think it would be a bit different, right? So this is my second point. And then my final point is, can international governance improve any of this? And so here I would say, look, there's a bunch of stuff that international governance can do, which is sort of this laundry list of imperfections that economists typically do recite, right? Coordination failures, information problems, problems of last resort lending, all those great things. But then, of course, it cannot get into the deep obstacles that are political nature, whether domestic, geopolitics. Now, does it mean that it's necessarily ineffective? The answer is no. And so the main reason, I think, why IMF lending policies and debt policies should be revised regularly is because the deep causes of delay tend to shift over time. So with respect to the policy of lending into official arrears, there were essentially two main actions were taken. One was the creation of the policy, which was a reaction to the first invasion of Russia into Ukraine, and Russia as a holdout creditor, and that worked very well. And the reason was that Russia was small. Now, then the question is, what about now? China. China is big. China is a cause of delay. Can the lending into arrears policy do anything about that? And the superficial answer is, probably not. First of all, because you really can only impose things on creditors when they're small, not when they're in the majority. But then there's a deeper reason around this, which is that if you go and lend into arrears in a situation where these arrears are held by a large and powerful creditor, you're not completely sure what this does to your debt sustainability assumptions, right? Because that creditor has essentially not taken part and may get serious at some point, at some later stage after you have invested all this money at the IMF. And that is sort of the deep hesitation, okay? And now, if that is the deep hesitation, then it obviously makes sense to say, look, let's not mechanically then focus on whether the restructuring has happened, but let's take, in a situation where lending can be really useful, where there are big stakes, let's take, if you like, a more of a probabilistic approach and say, look, we're going to take a judgment on the causes of the delay, why China or other countries have not agreed to participate in restructurings up front. And if we think that this is a problem that, for example, is driven not by a deep geopolitical reluctance, but by institutional issues in China that will likely sort them out themselves over time, we should go ahead and lend, right? And this is how I would rationalize the most recent change in official arrears policies of the IMF, which came out in April. So I think it's a good sign that yeah, I mean, international governments does work, can ameliorate problems, even if it cannot deal with some of these deep problems directly.
Thank you, Jeromin. Thank you for your mildly optimistic conclusion. Let me, before we close this discussion, let me give a chance to all panelists to come back and have one short comment on anything you've heard, you wanted to react to, or maybe just something you forgot to say. It's an option. But yeah. Okay. No. Okay. So let's maybe we have a Martin, Martin, you're our boss. You're our creditor. You lend us the time. So that's right. Let's take 10 minutes. So let me open the discussion with the floor. If there is any question from the floor, and then we'll come back to the panelists. Yes.
My thanks to the panel for the very interesting discussion. I want to, I'm Mark Flanagan, Deputy Director from Strategy Policy Review in the SP in the IMF. So I want to throw something out for the panel's reactions. So our take is that the narrative on debt is lagging a little bit the actual developments in this area. And in part, that's because we haven't seen any new restructuring cases, so that the lessons learned from the sequence of cases in the last 5 years have not had a chance to play out in the new cases. So in fact, our take is that if you think about geofragmentation, this is something the IMF has been very publicly concerned about. And in the economic space, one of the areas that has been most problematic has been trade and subsidies. But we classify debt now, and this might surprise people, into the category of small s success. Why do I say that? Because we have got the international community to come together in the context of the GSDR, Global Sovereign Debt Roundtable, to try to sort through problems. We have published a series of reforms to IMF policies in April, and I can tell you they were not easy to get approved. It took a full year, 3 consultations with our board, long consultations with our shareholders. And just as an aside, I can tell you as Deputy Director of Strategy, Policy and Review, this whole shareholding issue doesn't matter for big reforms. We would not have gone ahead with those reforms without China. So I'm curious about your view on this matter of narrative, on how you see the narrative in the debt area relative to geofragmentation.
Okay, thank you. Anyone wants to reply to that? Reza? No.
I think maybe, I mean, everything Mark that Mark has said is correct. I would just try to suggest that I think, now having, used to be at the IMF, Mark was my successor, in fact, in my division, then having been on the other side, I find that countries, I mean, again, I'll go back to if today, so I don't speak for Pakistan right now, I speak just, with my own views, but if I was to put my shoes in put myself in the shoes of a Pakistani official, I would tell my Prime Minister to run away from, anything like a common framework right now. And it's precisely for the reasons that Jeromin and you and others were mentioning. Because for a Prime Minister, the politics of this would be the following. You get into a framework, you upset some of your biggest supporters recently. Because that framework is going to essentially get others to be generous with the money that China and others have given. Probably this IMF program will not last too long. There's a time-honored tradition of going off track when other funding sources come about. So what are you going to be left with? You're going to be left with having burned your bridges with the few creditors who were willing to give you money. And now you have needs and you don't have sources. And so thinking a little bit in terms of the incentives for the debtor countries. I mean, there's so much framing that comes from the creditor side, but thinking a little bit about the incentives from the debtor side, I think would be helpful. And this is not to say that the common framework is, that bad. It's just those considerations that I think are not taken that much into account. What that means then, Mark, is delay from countries like Pakistan, because they will wait till the very, very last minute then to be forced into a situation like that.
Perhaps the only point I would add from the private side is, again, we were on the steering committee of Zambia and we went through the common framework, and we think, broadly speaking, the outcome of that framework was a successful result. So for us, perhaps the focus is less on the process or the framework, even though we can always improve it, but more the focus on a bigger picture. And the bigger picture is, when we talk to our investors, who again are taxpayers in most European and US countries, and as well as US and Canada, we sell them the case of investing in emerging market fixed income, which is not separate from the case of individual frontier countries that are going through crisis. And I think the challenge is that this experience of defaulted countries forms the view on the broader asset class, which is something which I feel is overlooked by, at times, by official sector, whether it's IMF or whether it's multilaterals, and it taints the ability to provide funding to a much broader asset class. And so perhaps my feedback here would be, yes, you're absolutely correct. We have seen improvement in the policies, and yes, we understand it's not been easy, but we wanted, I guess our point would be, those two themes are very much linked at the hip. And in order to solve that situation, we do need to work much closer together going forward.
Thank you, Polina. Yeah, Jeromin.
Just a small point. So, Reza, I agree completely. If I were in your shoes, I would advise the Prime Minister the same. But you're speaking for a country that can still get loans from that large creditor, right? So this is a situation where you have the luxury of not going to the common framework. If you actually couldn't do that, I think you would be grateful about the common framework. It would be much easier to restructure than without it.
Okay, one last question from the audience. Yes. Yeah, sorry. Yes. Please,
okay.
please go ahead.
Okay. I'm Yana Vitesva, University of California, visitor here at PSC. So I still have a hard time, and my question is for Polina, but everybody else, if you have comments on that. I still have a hard time to reconcile your positive spin on geopolitical tensions and findings of studies that show that geopolitical tensions lead to lower FDI, higher inflation, slower GDP growth, and loss of social welfare. And I was wondering if there was another culprit, another reason behind this positive economic growth in emerging market countries, and this is the US monetary policy, right? We know that the Federal Reserve Bank increased interest rates because of energy inflation and inflation in general, which led to depreciation of currency in emerging market countries, which prompted or increased exports. Couldn't this be, I don't know, complementary, or the reason behind its success? Thank you.
Sure. I'm pleased people are listening. I was, this comment was designed to be slightly controversial because my starting point is, firstly, when investors look at geopolitical risk, they say we do not want to touch this emerging market world because naturally you assume that that risk brings much weaker fundamentals, much higher defaults, et cetera, et cetera. What I have been positively surprised with is the fact that almost when we have seen elevated geopolitical tensions, in some cases, this actually redirected flow in a relatively, if you will, organic way, economic flow of activity, which did not cause a much sharper drop in GDP on certain countries. In other cases, I actually do think that, for example, if we take Middle East as an example, because Middle East as a region is so fearful of geopolitical tension, escalation of those tensions put them in front of a choice. How do we respond? And the choice is we either escalate it further or we try through economic influence to actually, to some degree, mitigate further escalation of that conflict. And my read is that what we've seen happening in Egypt with the multi-billion loans is an example of the latter. And I think it's actually quite constructive that when countries are put in the front of making a choice, the choice that so far have been made is positive for economic growth and for support of those more vulnerable players. Now, does that mean, again, I want to be very clear, I'm not suggesting more conflicts, but what I'm suggesting is that the robustness of emerging market economies has not substantially deteriorated despite geopolitical risk, which has increased.
So Layna will have the very last word.
Just 2 quick points then. One is on this question about the effects of war on performance. And I think that the thing that comes to my mind is what's the counterfactual, right? In a world in which these wars didn't happen, what performance have looked like, right? They may have been okay, but would they have been even better off? And then just to bring together what Polina and Reza had said in response to Mark Flanagan, it seems like there are really big distributional issues at play here. So Polina would say, well, we have to think about the distribution in terms of creditors taking losses. It's about members of the mass public who ultimately hold the assets. But it's also about citizens, right, in debtor countries, right? And they're also thinking about the losses they take and what the implications of austerity or restructurings are for them. And I think from that point of view, then the success is often very much in the eye of the ultimate beholders.
Thank you very much for what has been a very substantial discussion. Thank you to all speakers.